All right. Well, welcome everybody. So this is a great opportunity for many charities to be on this webinar together and learn about some of the recent tax changes that have taken place. I'm Jim Murphy from Episcopal Relief and Development, joined by our wonderful expert, Juan Ross, also in pink today, as well as Phil Purcell, who is General Editor of Plan Giving Today. And Episcopal Relief and Plan Giving Today are the co-sponsors of this webinar. Episcopal Relief and Development partners with faith and community leaders around the world to advance lasting change in communities impacted by injustice, poverty, disaster, and climate change. We focus on four interconnected priorities: early childhood development, women and girls climate, resilience, and disaster response. And just to speak for Phil momentarily, you'll hear from him later in our workshop. Phil is the general editor of Plan Giving Today, the premier resource for folks like me in fundraising that need to rely on their insights and articles on plan giving and other complex gifts. And I'd like to introduce now our primary speaker, Juan Ross. And just to read Ron Ross's extensive, but brief bio, Juan is a partner at Forum Financial, an independent financial planning and investment management firm. Prior to launching his financial practice, Juan held various senior fundraising positions at the Ronald Reagan Presidential Foundation, Occidental College, and the ALS Association, helping to raise millions of dollars in current and deferred gifts. And I'm now going to turn the floor over to Juan and just remind everyone, now that I've cleared the error message that popped up on the screen, we are still recording this webinar, so it will be available to everyone after the fact. And please type in your questions. I know we have received a few questions in the registration, but and I'll be going back to those. But please, Juan, I am now going to stop talking, which is something I rarely do, and ask you to take us forward into this review, very important review for donors and the changes in the tax laws. Thank you.
Great. Jim, thank you so much. I really appreciate the invitation and all the work that you put into organizing this webinar. So I want to thank you and Episcopal Relief and Development. And I want to thank Phil and Plan Giving Today for co-hosting as well. I'm also on the editorial board of Plan Giving Today, and I don't know if this prompted Jim or not, but I wrote a cover story in the September issue that's all about the one big beautiful bill. And so today we're going to take a little bit of time to break down the rules and the things that you need to know from the new tax law. That's the One Big Beautiful Bill Act, colloquially referred to as OBA. And so because of that, I thought, in order to add a little bit of fun to today's presentation, if you're a fan of 1970s Swedish pop band ABBA, then you may find a few clues sprinkled throughout the presentation. We're talking about OBA, but you will also find various ABBA song titles sprinkled throughout the presentation, just to make it a little fun for everybody, because tax law can be a bit of a dry subject. But let's get right into it, and let's start with how we got here. Does your mother know how we got here? Does anybody know? Yes. How we got here is because of the Tax Cuts and Jobs Act, TCJA. You'll recall that this law was passed and signed by the president in December of 2017, and it made some really significant changes to a lot of longstanding tax rules. However, the way it was written, and because of the way that the legislation had to be paid for, many of those rules were scheduled to sunset after December 31st of this year. And so it's like, so leading up to this year, it was like SOS, this would have been a Waterloo moment if a lot of these rules had been allowed to sunset. But until we did get the One Big Beautiful Bill Act, OBA, that was signed into law on July the 4th of this year. And what OBA did was primarily it extended many of the Tax Cuts and Jobs Act's rules, and it made them what we call quote unquote permanent. Now permanent, just as permanent in this context means that many of the rules in OBA, unless they're indicated otherwise, and you'll see in some of the slides to follow that some of the rules are not quote unquote permanent, but even the ones that are considered permanent, it just means that they're not scheduled to sunset. Much like the rules from Tax Cuts and Jobs Act, which were scheduled to sunset, these rules are not scheduled to sunset, which then makes them technically permanent, but a future Congress can always make any changes that they want. So even if something is permanent under this law, that doesn't mean it's permanent forever. So just be aware of that. The other thing that OBA did was it added some unusual new provisions that planners should know, a couple of them in the charitable world, which we'll focus on as we move through the presentation. But let's start with estate tax. And so Happy New Year. You know, if it hadn't been for OBA and you were at a New Year's Eve party on December 31st of this year and the estate tax rules were scheduled to sunset and the ball drops and now it's January 1st, now we would have been under a much different estate tax regime than we are now, thanks to the One Big Beautiful Bill. It made some significant changes, and the primary thing that it did was it made the higher estate tax exemptions, which were started under the Tax Cuts and Jobs Act, it made those permanent. So as a refresher, the current 2025 lifetime either gift or estate tax exemption amount, so that means the amount of wealth that one can transfer either during life or at death, it's a combined number, it's a unified number, is 13.99 million per person. They couldn't just add another, $10,000 to that to make it even 14 million. But anyways, it's 13,990,000. And again, before OBA, that would have dropped to around 7 million, which would have caused a lot of people in that net worth range of 7 to 14 million to suddenly have an estate tax issue. But now it's now set at $15 million, and that starts January 1st of 2026. And that $15 million, it's an even $15 million for next year per person with future inflation indexing thereafter. So we have some good planning opportunities here because now there is certainty. A lot of estate attorneys, people that I know in the financial world, were kind of playing a wait and see attitude if their clients may have been subject to the estate tax had OBA not gone into law. But now we have certainty. So now for those that are still subject to the federal estate tax, now remember that some states have their own estate and inheritance taxes at various levels. But for those subject to the federal estate tax, now we can start planning with this certainty around things like gifting to the next generation, and particularly with charitable planning, donor advised funds, especially funded testamentary, charitable remainder trust, lead trust, beneficiary designations on retirement accounts, all of those strategies that were in place prior to OBA are still going to be very powerful for those that are subject to the federal estate tax, even at this higher $15 million per person level. So a lot of planning opportunities, a lot of things to talk to donors about if they fall within that net worth range. But the majority of the changes were on the income tax side of things. And so we're talking money, money, money. That's another ABBA song title. You'll notice that they're all in italics, by the way. I want to make it a little easy for you all to find them. So let's talk about income tax. So we start with the income tax brackets themselves. The Tax Cuts and Jobs Act, when it passed at the end of 2017, became effective at the beginning of 2018, it reduced all of the marginal income tax brackets. The highest used to be 39.6. The highest became 37%, and then it added a couple in between there. So now you have this 10, 12, 22, 24, 32, 35, 37. Well, those were going to sunset, but now those are made permanent. So those tax brackets are now set. Now there is a minor, or what one might call a chiquitita change, that OBA adds this extra inflation adjustment only in the 10 and 12% brackets, and that starts in 2026. And basically what that means is that the income thresholds for those brackets is just a little wider than they are for the other ones, which will help people in the 10 and 12% bracket and people on the bubble before they bump into the 22 or from the 10 to the 12, they are more likely to stay in the lower bracket because of that little extra inflation adjustment. Not anything to be terribly concerned about. It's just a little relief. There is no change, by the way, to income thresholds for capital gains. So you want to be cognizant of this because where the income thresholds on the income tax brackets, where those fall, is not the same as this income thresholds for capital gains, going from 0% capital gains to 15% long-term capital gains, and then from 15 to 20. So I have an example here that going from 0 to 15% capital gains, that happens at $96,700 of income, whereas going from the 12% to the 22% bracket is at $96,950, and that's married filing jointly. So there's this weird couple $100 difference. Again, not something to be terribly concerned about, just something to kind of be aware of. And particularly if you're speaking with the donor and the donor's tax preparer, just want to keep that in mind. But it's just kind of this little nuance that's it's a little annoying, I guess. It's not the same. But anyways, the other thing that Tax Cuts and Jobs Act did was it established these higher standard deductions for all taxpayers. And now OBA has made those permanent. So instead of dropping back down to a lower standard deduction amount, we now have these higher standard deduction amounts. And the standard deduction amount that was originally announced at the end of last year for 2025 was increased slightly now for 2025 with OBA. So it went up by another single $750. Married filing jointly, it went up by $1,500. So just know that the standard deduction for 2025 is a little different than what was originally announced, and that was under the law. But in addition to making the standard deduction permanently higher than it had been before the Tax Cuts and Jobs Act, there is this new, what we call a temporary additional deduction for anyone age 65 and older. So this is a new additional deduction. It is what's called a below the line deduction. Now, what does that mean? So think about how taxes get calculated. You start with all of your income and you add all of that up, and that's your gross income. Then there are some adjustments and credits to your gross income, and those get subtracted from gross income. And now you get adjusted gross income, or AGI, which we're all familiar with because you have charitable gifts that are pegged to AGI. Well, then after AGI, you have either your standard deductions or your itemized deductions, and then you get to your taxable income. And that's the number that where you pair it with the marginal bracket, and that tells you how much tax you owe. Well, a below the line deduction means it's after adjusted gross income. So it doesn't reduce adjusted gross income, it reduces taxable income. And that's a big difference, because AGI, adjusted gross income, is pegged to so many different things on the tax return that you always, the primary strategy was always to get adjusted gross income as low as possible. It's nice that it reduces taxable income, not quite as powerful on the rest of the tax return as reducing adjusted gross income. Okay, but let's leave that as it is. This new additional deduction is $6,000 per person, assuming the taxpayer is at least 65 or older. Now, this one is one that is not permanent. It's available starting this year, 2025, all the way through 2028, the end of 2028. And it's available whether you take the standard deduction or you itemize. So it just it comes off your adjusted gross income as a deduction. It is subject to income phase outs, meaning the more income that you make, the less of this additional deduction you might get until you're completely phased out. So once you hit $75,000 of income as a single taxpayer, or $150,000 as married filing jointly, it starts to phase out. So you don't get the full $6,000. And then if you are over 175 or 250 of income, you don't get this additional deduction at all. But for married couples who are both age 65 or older, and many of our donors fall in this category, and they're below the income phase out because maybe they have some investment income, maybe they have Social Security, and they have maybe a pension or some other kind of income stream, but they don't hit those higher numbers. This is really powerful. They could have a total deduction between the normal standard deduction, the normal age 65 deduction that's always been in place, and now this new temporary deduction for at least the next 4 tax years, $46,700 coming off of their taxes. So this is really good. This is really, really powerful. So if only one of us is 65 or older, meaning one spouse, they still get the $6,000, but not the full $12,000. So that couple could get $39,100 of possible standard deduction, really of possible total deduction, the standard plus this additional. Really, really great benefit. We're doing a lot of planning with our clients around this, something to keep in mind. But just as a reminder, taxpayers take the higher of the two, the standard or the itemized deduction. And after Tax Cuts and Jobs Act, because they increased standard deduction so high, many taxpayers were forced out of itemized. They didn't have enough itemized deduction to exceed what the new standard deduction was. And so there are fewer taxpayers, and this has been found in the data, fewer taxpayers who itemize now than before Tax Cuts and Jobs Act. And remember that charitable deduction is an itemized deduction. So for quite a while, for standard deduction taxpayers, they have gotten no tax benefit for making charitable gifts. That hasn't necessarily stopped giving, because if you look at Giving USA's numbers, those continue to go up. But the fact is that many taxpayers who will take the standard deduction and make charitable gifts have not really been getting any tax benefit. Except now we have a new benefit under OBA, which we'll talk about in just a little while. Another major change under OBA, which will impact itemized deductions, which include charitable, is this SALT deduction. You've probably heard a lot about this. It was really in the news a lot. So SALT stands for state and local tax. It's a deduction that's always been in place. It comes on, it gets taken on Schedule A of the tax return, and it was unlimited until Tax Cuts and Jobs Act said, nope, we're capping it at $10,000. So if you pay state income tax and you have property taxes, add those up. If it's more than $10,000, you're out of luck. It's capped at $10,000, and that started with Tax Cuts and Jobs Act. But now under OBA, you have an increase in the SALT deduction to $40,000, and that starts this year. Some of these OBA rules will start in the future, but this one is another one that starts this year. Now, this is also one that's not permanent. It's only available through 2029. And that $40,000 increase, the increase to $40,000, which is the new maximum SALT deduction, it increases 1% per year starting next year. In 2030, unless Congress changes this, it will revert back to the $10,000 cap that was put in place under Tax Cuts and Jobs Act. It is subject to income phase outs based on something called modified adjusted gross income, but just for ease, let's just refer to modified adjusted gross income as being the same as adjusted gross income. There's a couple little nuances, but it's not important. And even if you're totally phased out because you earn too much money from the $40,000, you'll still get the minimum $10,000 on the SALT deduction. So this is something that, again, it will impact a lot of taxpayers, particularly in high state income tax states. They'll be very happy that this is now a thing, assuming they don't hit those income phase outs. A real quick one for business owners. Business owners in high state income tax states, we're doing something called paying a pass-through entity tax. So if they had an S corp, an LLC, any kind of business where the business itself is not taxed, but the tax for the business passes through to the owner of the business, that's a pass-through entity, the business is disregarded for tax purposes. A lot of states had put this workaround where the business basically pays the state income tax for the business owner, and that's a way of getting around that SALT cap. Well, OBA made no changes to that. So basically that workaround, if it's still needed, even with the higher cap, is in place. The winner takes it all. This is a good thing for business owners. So just something to keep in mind. Now, there's an unusual thing that OBA added to itemized deductions, and that is a limit for anyone who's in the very highest, that 37% bracket. There's this new limitation. It starts next year. Basically, the formula is all of your itemized deductions on Schedule A, your SALT deduction, your charitable deductions, medical and medical expenses, those are the three main categories. There's a couple others, are reduced by this 2/37 fraction. Basically, what that means is if you're in the 37% bracket, prior to this rule being put in place, for every itemized deduction, you'd get 37 cents of benefit of a deduction. Because you're in the 37% bracket, you're getting a deduction, so you get this benefit. Well, now your benefit is limited to 35%. It's as if you were in the 35% bracket and you get the itemized deduction benefit at that level. So it's basically a 2% haircut on all of your itemized deductions only if you're in that highest tax bracket. And unfortunately, that's the name of the game. You only save 35 cents on the dollar, not 37. So it is very high income thresholds. So you have to be having more than $626,350 of taxable income as a single person and $751,600 as married filing jointly. But those donors are out there, and so just know that they're going to get hit with this little haircut on all of their itemized deduction. So that leads me into some changes specifically to charitable giving under OBA. Number one is that 37% itemized deduction limitation that I just mentioned. So charitable gifts are an itemized deduction, and they will be subject to that limitation if the taxpayer falls in that 37% bracket. The second one is this really unusual, this new floor for charitable contributions, and that starts next year. So we're all familiar, we should all be familiar as gift planners with those existing upper adjusted gross income limits of 60% for gifts of cash, 50% if you take basis, unappreciated assets, 30% for appreciated assets, and that's to public charities. And there's the lower AGI limits for gifts to private foundations and so forth. But this new floor is an addition, and what it is a 1/2 of 1% floor. So in other words, your adjusted gross income, multiply that by 1/2 of 1%, and your charitable gifts have to exceed that floor in order for you to get any benefit. And basically, your total deduction will get reduced by that 1/2 of 1%. So here's an example, just to make it a little easy. So we have Fernando. His adjusted gross income is $200,000. He makes a $5,000 gift to his alma mater's I Have a Dream capital campaign, and he itemizes his deductions. Okay, what deduction does he get for his $5,000 gift? He only gets a $4,000 deduction. Why? Because 1/2 of 1% of his adjusted gross income, which is $200,000, multiply that by 0.5, that's $1,000. So he loses that first $1,000 of deduction, just doesn't get it, and he gets a deduction for $4,000. And that's how that works. A weird wrinkle in the law is if you have a donor who exceeds their upper adjusted gross income limits, you know how you can do that, and then the excess can carry over for up to 5 additional years, then the amount that's disallowed under the floor, this 1/2 of 1% floor, also carries over. Will it get absorbed in the next year? It depends on the next year's adjusted gross income, doesn't it? So that's how that works.
Juan, I just wanted to jump in just for a half second, and that is just a quick reminder. Yes, we do for sure have many people on the line who are fundraisers, but we also have many, many donors out there. So just a quick reminder on that. But this is a really, really important example. And just reminding everyone, if you have questions, I already have 1 or 2 that have come in, please, as Juan is speaking and a question comes to you, please type it out so that we can go through those later, because we are going to pause and answer as many questions as possible.
Yes, thanks, Jim. Okay, the third major change for charitable giving under OBA is the return of the charitable deduction for standard deduction taxpayers. Now, you might remember, if you were in this field during COVID, that the CARES Act, which was passed, provided a similar deduction, and it made it available during the pandemic for a couple of years. The rule under OBA now is that for those who take the standard deduction, they can take either $1,000 if they file single or $2,000 if they file joint as an additional charitable deduction. It's not on Schedule A itemized deduction because these taxpayers don't itemize, but it's simply an additional deduction that they take against their income, and that starts next year, 2026. You don't have to worry about that 1/2 of 1% floor because that's only for itemized deductions, and this is not that. And the rules for this additional deduction are very similar to the rules under the CARES Act, which means it's cash only. No appreciated stock gifts. So you have to make a cash gift of up to 1,000 single or 2,000 joint. And the gift has to go directly to the public charity, not to a supporting organization, and not to a donor advised fund, even though technically a donor advised fund is considered a public charity. That doesn't count for purposes of this deduction. And again, this is a below the line deduction. So it doesn't reduce adjusted gross income. It reduces taxable income. Still nice to have. It's better than not having it at all. So just know that this is available, and this is going to be a really big one. And I'm going to get back to it in just a couple of more slides. But there's the fourth change, not as major, but there's a new credit that's going to start in 2027 for gifts made to what are called scholarship granting organizations, or SGOs. SGOs are organizations that fund K-12 scholarships in their state. The trick with this new credit is that states have to opt in to participate. They have to submit a list of their qualified scholarship granting organizations. The tax credit is up to $1,700 for gifts made to these organizations, and then they will then make the scholarships. Now, because states have to opt in, this one has already gotten a little political. You have some states that are saying we're not going to participate for various reasons. Just whatever state you live in, check your rules starting in 2027, because this could be, if it's available, it could be a nice additional tax credit to donors and taxpayers. So summarizing charitable planning under OBA, and then we're just going to wrap up with a few additional unusual things that OBA established. It really depends. What is the right strategy to take? It depends on the donor's adjusted gross income. That's a huge factor here for a lot of reasons, their age and the amount of their annual giving. From my perspective, generally speaking, if the donor is subject to required minimum distributions because they are at least, well, I don't want to say they're at least 73 because they could be subject for other reasons but if they're subject to required minimum distributions, giving via qualified charitable distribution or a QCD is still going to be the most tax efficient way to give, especially if their annual giving is relatively small, because qualified charitable distributions reduce gross income. Remember, I've been talking about below the line and adjusted gross income. A QCD will reduce gross income because it's otherwise would have been taxable as part of a required distribution. And reducing gross income reduces AGI. And reducing AGI is good for a lot of different reasons on the tax return that have nothing to do with charitable giving. Things like how much Social Security gets taxed, Medicare premium adjustments, possibly the threshold for medical expense deductions on Schedule A. There's a bunch of things tied to AGI. So we always like when we can reduce AGI versus the non-itemizer credit, which does not reduce AGI. So I would say QCDs, think if they are subject to required minimum distributions, that should be the number one way that they give. Now, if the donor is a super trooper when it comes to giving, in other words, they make large donations, generally speaking, every year, think 10, 20, $50,000, and they don't itemize because they don't hit the standard, they have the standard deduction. I guess 50,000 they would potentially itemize, but if they make large enough gifts, but not so large that they can itemize, then yes, take advantage of that new non-itemizer credit first by encouraging them to make cash gifts of $1,000 or $2,000, and then do QCD gifts after that. That'll be a very tax efficient way to give. Okay, so what do we do this year? Again, make gifts using qualified charitable distributions if eligible. That's really still going to be the best. You also want to talk to donors, and we only have a few more months. We're entering the fourth quarter, about accelerating future giving into 2025 when possible. It's not always possible, but if they can, this will be good. Again, that bunching, that was a strategy after Tax Cuts and Jobs Act, because bunching gifts would move taxpayers above the standard deduction for that year so that they can itemize. That's still a thing. And bunching multiple years of gifts into this year will help donors get ahead of the changes coming in 2026, which would be that 0.5% floor. It's not in place for 2025. So to the extent that they may lose some of their itemized deductions with that floor, you want to make gifts this year if you can. And that 37% bracket limitation also starts next year. So for the highest income earners, if they can bunch their charitable gifts into this year, they'll get a better benefit than if they wait until 2026.
And
All
this
right.
is a really crucial point, Juan. Thank you for making it. One quick clarification, which is an early question I'll bring up, is regarding donor advised funds and contributions to donor advised funds, which is normally what people use for bunching their giving. Can you just repeat what people should be thinking about when it comes to donor advised fund giving in this year?
I'd say, yeah, sure, absolutely. So I think if we're talking about 2025 giving, absolutely, bunching into a donor advised fund is a great way to go. Starting in 2026, you just want to be careful because, again, that cash gift non-itemizer deduction is not, donor advised funds don't count for that. And of course, QCDs, you can't do those into a donor advised fund at this time. So I say for 2025, absolutely. I think they're still going to be very valuable beyond 2025 because no matter if you give to a donor advised fund or directly to a charity, notwithstanding that new $1,000 and $2,000 credit for non-itemizers, if someone itemizes, they don't get that credit's relevant.
That's a key point, right? If you don't itemize, for all the many donors listening to this webinar, if you don't itemize, you cannot. I don't want to be I'm not the tax guy. So Juan, can you repeat what they can't do?
Yeah, no, the credit, this one back here, the charitable deduction for non-itemizers, they won't be able to take advantage of that, but it's small. It's it's $1,000 or $2,000. So if someone is a high income earner, it may not have as much impact, and they may just want to go ahead, It really depends. Again, this is why a donor's age, the amount of giving they do each year, and their adjusted gross income, regularly speaking, but year to year, those are going to be major factors driving how they should give in order to do it in a tax efficient manner.
Thank you, Juan. And for those listening, we are going to try and summarize this central giving aspect as well. But please go ahead, Juan.
All right, just a few more things. Oh, well, let's talk about what to do in 2026. So as I've been alluding to, tax planning is going to be critical. We're going to, at least with our clients, we're going to encourage them to start going to their tax preparers. We've been doing this all along anyway, but it's even more important now with all these different credits that are based on different adjusted gross income numbers. And it's gotten, frankly, a little bit more complicated, which tax law tends to do. And so getting a tax projection with a tax preparer at the end of the year as a sort of a pro forma of what does my income look like, where do I think I'm going to land, and what steps should I take before the end of the year? That's going to be really important to know where any individual taxpayer stands. And the other thing I would add is that you want to also follow what I call the giving order of operations for maximum tax efficiency. I wrote an article about this in Plan Giving today, but I'm going to give it to you here. This is simply from a tax efficiency standpoint, nothing else. And so there may be reasons not to do this, follow this order, but if you just want to be tax efficient, I've already kind of talked about QCDs, but if a donor itemizes their deductions, I still say go with a qualified charitable distribution if they're eligible for that, because it's going to lower their income. Appreciated, if they max out on QCDs, then go to appreciated securities. I mean, if someone's really very, very generous, sure. And then if they want to give even beyond the appreciated security amount, maybe that they have in mind, then you go to cash gifts. That's if a donor itemizes. And remember that appreciated securities, gifts, and QCDs, they take a little time. So be sure that the donor initiates those well before December 31st. You don't want to get into a crunch in that last week of the calendar year. So that's if a donor itemizes. Now, if a donor takes the standard deduction, the order changes slightly. Now you want to do the cash gifts up to the maximum for the non-itemizer deduction, with a caveat that if the donor's giving is going to be less than $1,000 or $2,000 and they're eligible for qualified charitable distribution, I say you still want to take qualified charitable distribution. In other words, if their giving is so small that they're not going to hit those cash gift limits for non-itemizers, don't even bother. Do the QCD if they're eligible for that. But let's say that their giving is going to be $5,000 or $10,000 or $20,000. Yes, definitely take advantage of that non-itemizer deduction maximum, then stop there, $1,000 or $2,000, then go to qualified charitable distributions if they're eligible, then go to appreciated securities if they max out on that, or if they're not eligible, then additional cash gifts would be the last part of this order. So that's, again, just for tax efficiency. It used to be much simpler, but now we have two different orders if someone itemizes versus if someone takes the standard deduction. And the standard deduction one depends on how much they give on an annual basis as well. So I'm sorry that's complicated, but again, you can blame Congress for this added complexity. What else should donors do? Review their estate plan. We like to have clients review it every 3 to 5 years, just to make sure everything is still in order. Update beneficiary designations, and we're talking about retirement plans, IRAs, 401ks, 403bs, life insurance policies. Make sure those designations are up to date. And don't let the tax tail wag the dog. You know, this is what we're talking about here is tax law. And yes, it will have an impact on a donor's decisions, but ultimately it's not always about taxes, and it shouldn't really be about taxes. It's really about giving to causes that they care about, the mission of the organization, and that's really what should drive the giving. And then you kind of do the tax planning around what they want to accomplish based on that. So that's kind of my approach to this. Let me just briefly touch on some other non-charitable changes under OBA that might be of interest. There are these other new below-the-line deductions: no tax on tips, no tax on overtime. The president campaigned on those, and now those are in place. The income itself has to meet certain rules. It has to be qualified tips and qualified overtime. So just make sure that you know what those definitions are. If this is something that impacts you in any way. It is a limited deduction, so it only goes up to a certain amount of dollars. And it also has income phase out. So the more you make, the less no tax on tips or no tax on overtime you'll take advantage of. And it's only in effect temporarily. So this one is not permanent. It's only from this year through the end of 2028. There's also this new auto loan interest deduction. So this applies to any new new loans made after December 31st of 2024. The car itself has to meet certain rules. It has to be what's considered a qualified passenger vehicle. So make sure you understand what that means. Generally, the car has to be made in the USA. The deduction is limited to up to $10,000. It also has income phase outs. So the more money you make, you may or may not be able to take advantage of this new deduction. And it is also temporary, same as the tips and overtime, 2025 to 2028. A couple of changes to 529s. The list of qualified expenses for K through 12 expenses, those have now been expanded, so you can use your $529 for more things. And it increases the annual limit for those K to 12 expenses to $20,000 starting next year. There was a lower limit, now it's higher, and the list of qualified expenses is expanded. So that's a good thing. So like things like tutoring outside the home or fees for standardized tests or AP exams, which couldn't be covered before OBA, now those can be covered with $529. And there's this new qualified expense for a post-secondary credential. So for example, if you're looking to get the CFP certification like I have, now someone could use their $529 for that. So there you go, a nice little expansion. For health savings accounts, HSAs, we are huge fans of health savings accounts. We love them. They're triple tax benefit. The definition of what a high deductible health plan has now been expanded, that definition. So it includes bronze plans and catastrophic plans that are offered on the Affordable Care Act exchanges. Before, those were not health savings account eligible. Now they are. That's really good. And there's also for like people who won't go to concierge doctors, there was a doubt or a question as to whether or not that would qualify as an expense to be paid out of a health savings account. Now it is clear that yes, you can pay for what's called a primary care arrangement with your health savings account dollars. So again, just expansion of some of these existing tax strategies under OBA. There's a new retirement account for minors, which is at least for now called a Trump account. So I'm not going into the politics of it. That's just what it's called under the law, just so that you are aware. This, again, a retirement savings account for minors. The rule is that the individual has to have a social security number. If they have that, they can open a Trump account. Now, there's all these different rules that you see on this slide here. The Trump account can be funded from birth, as once they get their social security number, through until they turn 17, the year they turn 17. Then the funding ends. It's up to $5,000 per year that can be funded with. There's no income requirement. In other words, the minor doesn't have to be working in order to be eligible to make that $5,000 contribution into their account. Employers, if they are working, like in their teen years, can contribute on behalf of the employee. And it does not limit your ability to contribute to an IRA. So you can actually do both if you have the income, particularly we're talking about like teens who have summer jobs and things like that. Now, the investments that are eligible for this so-called Trump account is limited to U.S. stock index funds, and they have to have a very low expense ratio, which is the cost you pay as an investor to the fund. So very kind of limited investment options, which is not great. I'm not crazy about that, but and you can't distribute the money before the beneficiary turns 18. But the year the beneficiary does turn 18, those investment rules no longer apply. Now you can have more broadly diversified investment portfolio. It looks like an IRA, but really this is very early on this. So I'm just giving you kind of what the law says. We need IRS to provide some guidance on this. Can a beneficiary roll their account into a Roth IRA? We don't know. It's unclear. Do those pre-age 59 and a half distribution, the penalty that applies if you take money out of an IRA before 59 and a half, does that apply to a so-called Trump account? It looks like yes. We don't know.
Okay.
What about required minimum distributions? What about post-death rules? It's unclear. Probably going to be the same as an IRA, but we don't know. So we're
So
waiting
it
for
sounds
guidance
like a
on that.
future review, maybe, but
Absolutely, yes. But here's the thing. So you can tell your donors who have
okay.
brand new grandchildren, if they have a child born 2025 or in the next 2 years, 2026 or 2027, the government, the US government, will fund $1,000 into their Trump account. Now, we still need IRS guidance on how that's exactly going to work. But even if that's all you do, you open a Trump account, you get your $1,000, and you don't give anything, you put anything else into it, it's $1,000 from the government.
All
So,
right.
but you have to have a child born in one of these 3 years.
All
Very,
right.
very unusual.
We're almost at the question and answer time. So
All right, and I'm almost at the end. So the clean energy credit, by the way, so the EV credit, if you're hoping to buy one, you should do it today because the credit goes away after today. There's a couple of residential clean energy credits that end by the end of the year, things like adding solar to your house. So you want to, if you haven't started that process, it may be too late. And that's it. So when all is said and done, there are a lot of changes, even more than I've described in this short period of time that couldn't fit into this big, beautiful presentation. Careful planning and collaboration with your donors, advisors, particularly tax advisors, CPAs, and tax preparers. But don't let good tax planning and your donors' dollars slip through their fingers because you want to take advantage of what's here. And again, finally, charitable giving is not really about taxes, but it's about the causes you care about. So I want to say thank you for the music. Here are some disclosures, Mamma Mia, it's a lot. And we can go on to Q&A.
Great. Thank you so much, Juan. I really appreciate all of that. And so we want to, of course, ask you a few questions, and I have several questions. If others have more, please do type them out. We'll try and get as many answered as we can today. Many people, as I mentioned to you, Juan, in the early questions when people registered were really interested in hearing more about RMDs, the required minimum distribution, and qualified charitable distributions. And
Okay.
one important question was, have there been any changes with respect to the so-called RMD, which people are typically required to start taking at the age of 73, for all those donors out there approaching that time? One thing I can say is that the max qualified charitable distribution in 2025 is 108,000. But are there any other changes that our donors out there and those other fundraisers on the line might need to know about changes in the QCD and RMD area?
Great question. OBA made no changes. So the changes were all under Secure Act 1.0 and 2.0, but this law passed this year made no changes. So you're still subject to required minimum distributions starting at age 73. That goes through 2030 or 31, and then it bumps up to age 75. I forget the exact year. It'll bump up at some point unless Congress changes things. But for now, it's 73. But qualified charitable distributions are still available starting at age 70 and a half. So this is
Correct.
something that I talk to fundraisers when I've given presentations on this is, does it make sense to do qualified charitable distributions at age 70 and a half if the donor is not subject to a required distribution until age 73? So there's this 2.5-year gap between the two eligibilities. And I say, yes, it's probably still the better way to go. Why? Because by taking qualified charitable distributions early before you have a required distribution, you're actually reducing the size of that IRA. If it's a very large IRA and you can make charitable gifts out of it, then the eventual required minimum distributions will, in theory, be smaller because the account value has been lowered through the use of early qualified charitable distributions starting at 70 and a half. But again, the donor should consult with their tax preparer because there may be other things in their situation that will preclude that.
And thank you for reiterating that. And that is true. We should have said that at the very beginning. You should seek your own legal, tax, and financial advice before finalizing any gift. This is general information just to help guide you through your thinking. Another quick question from the early questions was this one. And did the new tax laws impact complex gifts, such as real estate or business interests, which maybe some people would like to try and fund with a charitable remainder trust or more complex gifts? I know for everybody who's out there who may not know what those are, but many times people of greater means may be getting ready for retirement and may be considering making a gift of part of their business or of some of their real estate to a charity before it is sold, before negotiations have begun. And for some donors, significant donors, that can make a real big difference in their ability to be charitable. Can you say any comments about that, Juan?
Yeah, so OBBBA did not make any changes to complex gifts in and of themselves. It did make changes to the itemized deductions as I went over. So that's just something to be aware of, is that the available deduction, there'll be the deduction that someone is eligible for. For example, if they make a gift into a charitable remainder trust, they get a certain charitable deduction. But whether they can take that deduction once it's on their tax return, it's going to probably be reduced a little bit because of the 0.5% floor possibly the upper AGI limits, that 37%, if they're in the highest tax bracket, that gets reduced by a couple percentages. So there's no real change. These are still very good gifts to be considering and making. Absolutely. It's just really the amount of the deduction that the donor eventually gets will likely be lower under the new law. That's the only real difference.
Thank you. Another quick qualifying question from someone is about when someone makes a pledge of a large gift, right? I believe, and correct me if I'm wrong, but that would mean it's only when an actual transaction takes place that someone actually makes a gift. It does not impact pledges.
That's correct. If it's just a pledge on paper, regardless of whether that pledge is like a letter of intent or if it's a binding irrevocable pledge, there's really nothing from the tax standpoint that's happened until actual dollars are transferred to the charity. So there's really no difference there. It's only when an actual gift is made, regardless of the status of the pledge, that all of this applies.
Okay. A further clarification. So someone is referring to half of the 1% floor. Is that for all brackets? That is a little confusing to the average taxpayer. Can you say a couple words more about that,
Yeah.
please?
Yeah, so don't think of the half of 1% as applying to certain tax brackets or not. Think of it as applying whether if you itemize your deductions and it doesn't apply if you take the standard deduction. So again, that standard deduction is very high. And if you're over age 65, it's even higher for the next few years under the new law. But for anyone who itemizes their deductions, if you look on Schedule A, you'll see all of these deduction categories. Those are the charitable deductions. Those will be reduced. There'll be some new lines on that Schedule A that will calculate this new floor that will refer back to adjusted gross income on the front page of the 1040 form. But it only applies if you itemize your deductions and then you put charitable contributions as part of your itemized deductions, which you normally would. So that's what it applies. It doesn't matter what tax bracket you're in. If you're in the highest tax bracket, that 37%, then an additional haircut will apply to all of your itemized deductions, your medical expenses, your state and local taxes, your charitable contributions, and so on. So that 2% haircut applies to all itemized deductions on Schedule A, including the charitable, which the charitable will already have been reduced by that half of 1% on top of that.
To bring together a few questions all on the same basic topic of rolling over excess contributions. There are some times when someone would be making a large donor advised fund gift or a large gift to a charity and it actually goes above what they can deduct in that year.
Right.
It's a rare case, but it's having to do with their AGI. But can you say a few words about rolling over excess charitable deductions into future years and if that's changed?
Yeah, so no changes there. Well, technically, one change is that that 60% upper adjusted gross income limit for cash gifts, that's now made permanent. So we don't have to worry about that. But other than that, there are really no changes. So remember, now you have charitable gifts that are subject to an upper limit based on adjusted gross income and a floor also based on adjusted gross income. So, but the upper limit, let's say it's a cash, let's say a donor only gives cash and they've given in excess of 60% of their adjusted gross income, which is a lot of giving, but some people do it. There's nothing wrong with that. That excess that they cannot absorb in that current year gets banked. It's recorded on the tax return so that in future years you know it's there, and it can get rolled over for up to 5 additional years. So a donor has 6 years, 6 tax years in which to absorb any deduction made in that very first year. And so that's just how the rollover works, and it's absorbed until it's fully absorbed or until that 5th additional year passes. And if they can't absorb it all in that 5th additional year, then they just lose the rest of it. So that's how that works.
We have time for just a couple of more questions. And one is a clarifier because it does get confusing with qualified charitable distributions and take off an amount. That's how the question is phrased. But if you make a qualified charitable distribution greater than your required minimum distribution,
Right.
the excess above your required minimum distribution, that is simply a reduction of income, not actually anything that would count toward a deduction, just to
That's
affirm.
correctly worded, yes. So you have your required amount. Let's say a taxpayer has a required distribution of $20,000. Then you have your qualified charitable distribution maximum for the year, which is 108,000 this year. Let's say someone gives 108, but their required amount is only 20. Well, that excess is just it's non-taxable income. It's a distribution out of an IRA that would normally have been taxed. That's the key. Normally that would have been taxable income, but it's coming out as a qualified charitable distribution. It goes on the tax return as not a taxable distribution. And so it reduces the IRA. So reducing an IRA is, in my book, always good, because we've had decades now where people have built up 401ks and 403bs. They're taught to save for retirement, and then they end up in retirement with a huge IRA, and now they got to take these required distributions that are put you back in a higher tax bracket. So anything we can do to reduce the account balance of an IRA in most cases is a good thing. And so that's why taking excess qualified charitable distributions over and above a required distribution is generally a good idea. But again, each person is different. You have to look at the individual tax situation.
Well, thank you, Juan, for all of your sage advice today. We do have a few other questions that we don't have time to answer, but the three of us will bang our heads together and see who can answer the remaining questions and get back to you. But just thank you, Juan, for a great presentation and some very complex stuff. So we will be sharing with everyone the slides as well as a recording and my quick summary of the giving side of all of this. And I want to turn the floor over to Phil. And as I do, I just want to thank everyone who's attending here. And remember, it's that time of year when you are contemplating making your end of year gifts. If you haven't given out of your traditional IRA, want to make a QCD or a DAF grant, many charities, in addition to Fiscal Relief and Development, all the ones that are online listening in today really can be helped by end of year contributions. And as you have heard, this may be a good year to do that. And I will now turn the floor over to my friend and colleague, Phil Purcell, to say a few words to those fundraisers that are on the line listening in.
Well, thank you very much, Jim, and thank you, Juan, for an outstanding presentation. You can read more from Juan and Jim who author articles on a regular basis for Plan Giving Today. Plan Giving Today is a monthly newsletter. You can Google and find out how to subscribe, or contact me or Jim, and we can certainly forward you information about how to subscribe. It's an affordable publication, but it has proven practical advice. Nuts and bolts tax questions are answered, a lot of marketing ideas, donor relationship development ideas. We try to cover all aspects of planned gift fundraising. We get into non-cash gifts, asset gifts, giving trends and strategies as well. So please take a look, see if it's a publication that would be valuable for you or your group. There are group rates available. So if you're a large office and have a lot of people, you can subscribe to a electronic version and share it within the office as well. So thank you, Jim, for this opportunity. We appreciate everybody taking a look at Plan Giving Today so you can keep up to date with all the latest developments in Plan Giving. Thank you.
Okay, thank you, everyone. Thank you, Juan. Thank you, Phil. Thank you all for attending. Blessings as you proceed into the rest of this very festive part of the year. So have a wonderful day. Thank you all.
Thank you.